When gold was discovered at Sutter's Mill in January 1848, the metal that flooded out of California did not stay in California. Miners sold their gold to the U.S. Mint and to merchants, and those dollars flowed eastward into the bank vaults of New York, Boston, and Philadelphia. Historians estimate that California gold production reached roughly $40 to $50 million annually by the early 1850s, a figure that dwarfed anything the American economy had previously seen in a single year. Banks, suddenly flush with deposits, were under competitive pressure to put that money to work, and in the early 1850s, the most obvious destination was the railroads. American railroad mileage stood at roughly 9,000 miles in 1850. By 1860, it had grown to more than 30,000 miles, according to U.S. Census historical records, a tripling in a single decade. Much of that expansion was concentrated in the first half of the 1850s, fueled by bond issuance that promised investors a share of future freight and passenger revenues. State governments granted land to railroad companies on the assumption that settlement would follow the rails and make the land valuable. Speculators bought that land on credit, hoping to resell it once the trains arrived. Each link in the chain depended on the next one performing exactly as promised. By 1856, the revenues many railroads were actually generating had not matched the projections used to sell their bonds. Settlement of Midwestern lands was slower than promoters had advertised, and some lines had been built through territory that could not yet generate enough freight traffic to cover interest payments. Grain prices, which had been elevated during the Crimean War as European buyers looked to America for supply, fell sharply after the Treaty of Paris ended that conflict in March 1856. That price drop cut into the incomes of the farmers who were supposed to be shipping goods over the new railroads, reducing freight revenue precisely when railroad companies needed it most. Ohio Life Insurance and Trust Company was a Cincinnati-based institution with a large New York office that had been extending credit aggressively into railroad and land markets. On August 24, 1857, the company announced that it was suspending payments, unable to meet its obligations. Subsequent investigation revealed that the New York office had made loans well beyond what the company's capital could support, and some historical accounts indicate that the branch manager had engaged in unauthorized speculative transactions, though the full picture of mismanagement took time to emerge. Regardless of the precise internal cause, the effect was immediate. Ohio Life owed money to dozens of banks and creditors, and the news that it could not pay rippled outward. By 1857, wire networks connected the major cities of the eastern seaboard and extended into the Midwest. The transcontinental line would not exist until 1861, but New York, Cincinnati, and Chicago were already linked. The failure of Ohio Life was known in New York within hours of the Cincinnati announcement, a transmission that would have taken days or weeks by post just 2 decades earlier. Economic historians, including Charles Kindleberger in his study of recurring financial manias, have noted that technological acceleration of information is a persistent feature of financial crises, and 1857 is among the earliest examples in which the telegraph demonstrably shaped the speed and geography of a panic. Through September 1857, depositors across the Northeast began withdrawing gold and silver from banks they feared were exposed to Ohio Life or to weaken railroad paper. The pressure accumulated until October, when New York's major banks, facing demands they could not satisfy in hard currency, collectively suspended specie payments, meaning they stopped converting their notes and deposits into coin on demand. According to accounts compiled by financial historians, hundreds of banks across the North either suspended payments or failed outright during the autumn of 1857. The credit that had powered the railroad boom effectively vanished. American railroad securities had been widely sold to British investors throughout the 1850s, and British merchant banks had extended credit to American trading houses. When those securities lost value and American merchants stopped paying their bills, the stress crossed the ocean. British banks, particularly in Liverpool, found themselves holding paper worth far less than expected. Hamburg, which served as a major clearing center for transatlantic trade, experienced its own severe credit crisis in late 1857 as commercial bills went unpaid. Some economic historians describe the 1857 episode as among the earliest financial crises to spread across multiple continents within a single season, though scholars note that the Panic of 1825 also had international dimensions. The contraction that followed the panic hit the industrial North hardest. Factories producing goods for the westward expansion slowed or closed. Unemployment in cities like New York and Philadelphia rose sharply, and contemporaries described workers lining up for charitable relief. The Depression was severe but shorter than the one that followed the Panic of 1873. By 1859, economic activity was recovering in much of the North, though credit markets remained cautious. Estimates of the duration and severity vary among historians, but the broad pattern of a sharp contraction followed by a gradual recovery is generally agreed upon. The experience of the American South in 1857 was strikingly different from the North. Cotton prices, sustained by continued British textile demand, remained relatively firm even as northern markets collapsed. Southern planters and the banks that served them were less exposed to railroad bond speculation and less dependent on the New York credit markets that had seized up. This divergence fed a political argument that some Southern politicians made loudly, that the Northern economy rested on unstable speculative credit while Southern agriculture rested on durable productive wealth. Historians, including James McPherson, have noted that the Panic of 1857 deepened sectional economic tensions and strengthened the case, in Southern political discourse, that the two regions had incompatible economic interests. Before 1857, the United States had no national banking system and no uniform currency. Thousands of state-chartered banks issued their own notes of varying reliability. The panic intensified calls for federal oversight of banking, though the political will to act was tangled with the same sectional tensions the crisis had inflamed. It was not until 1863 and 1864, during the Civil War and driven primarily by the Union government's need to finance the war, that Congress passed the National Banking Acts, which created federally chartered banks, a national currency backed by government bonds, and minimum reserve requirements. Historians generally treat the 1857 crisis as one of the pressures that built the case for those reforms, while acknowledging that the Civil War's fiscal demands were the more immediate driver. The 1857 panic follows a shape that appears repeatedly across financial history, a period of genuine technological progress. In this case, the railroads attracts more credit than the underlying economics can sustain. A trigger event, in this case Ohio Life, reveals the underlying weakness, and faster than expected information transmission, in this case the Telegraph, accelerates the withdrawal of confidence before anyone can fully assess the actual damage. That same basic architecture recurs in later crises, with the enabling technology changing each time. The telegraph gave way to the telephone, then to electronic clearing networks, then to digital platforms and algorithmic systems capable of moving faster than any human response. The Panic of 1857 does not recommend any particular investment or predict any particular future event, but it illustrates something worth understanding about how financial systems behave. When credit expands rapidly to fund a new technology, the institutions and investors most concentrated in that credit are often more exposed than they appear from the outside. When confidence breaks, it breaks quickly, and the speed of that break is tied to how fast information travels in the surrounding environment. A diversified position spread across assets that do not all depend on the same source of credit or the same chain of assumptions has historically provided more stability than concentrated exposure to a single sector, however compelling that sector's story. That is a structural observation drawn from history, not a forecast about any market or asset today.